Good evening. How are you guys doing? I hope you're all good today. Just let me know, can you hear me? I don't want to speak to myself. Can you hear me? Let me know in the comments below. We're going to start very shortly, just after getting the confirmation that the audio is clear. So just let me know. All right, welcome. So today's class is all about risk management. How do you pre-calculate risk with any given strategy? That's what we're going to be talking about today. So welcome all. I see Mr. Moses says, hopefully you're not speaking to yourself again. No, I'm not. I was just running the chart for time's sake. All right. So I usually start the session with questions. What are the questions that you guys have? I know risk management is a concept that's widely taught, but in my view, it's not well taught. People don't show you how you can implement the risk management into the strategy. Everyone is telling you about risk to reward ratios, and just making sure that you take more than what you risk and all that. So it's easily said than done itself. So, what's your experience with risk management? How do you handle your own account? Let's get those comments coming so we can share with the rest of the viewers on what you guys are doing. Right. So if you don't get it, the question is what risk management strategies are you using and what's your experience with them? Or are you those type of traders that just don't have a risk management plan? You enter and you hope for the best. Just be honest, let me know. Got a comment from Mr. Moses. He says, I'm here to learn how to manage my risk because I'm one of those who jump in and babysit the position. Very honest one there. Thank you so much, Mr. Moses. Thank you so much for that. So there's quite a few concepts around this that I want to discuss, but I want to hear from you guys. What's up? How do you guys handle this trades? At least Mr. Moses came out straight and told us, "Hey, listen, I stocked the market." We've got another one from RST. The mindset of keeping the same energy is for me the hard part. I can follow my risk management, and then when the account grows, the overconfidence gets in the way. Wow. Wow. That deserves a sip of coffee right there. How true is this? This brings me to the story of us as all traders having to go through a point in our trading journey where everything is going right. You've been trading well, working hard over the days, and just when you get to that amount of money that you were always hoping for, always working towards, as soon as you get there, you lose the vision, you lose the goal, you lose everything, and you kind of figure that you can take it. The account is big enough, we can handle any type of risk. Let's go with it. And then it smashes you, it destroys you, and takes all that hard earned work that you've been putting up. And it's really hard to make it back from that. That I can promise you. It's very hard to make it back from a loss where you were running a streak of wins. And then you lose. One trade takes it all. And that's why this class is so necessary. I made it its own individual class because I thought that it'll be best if we focus purely on risk management and having nothing to do with the actual strategy. Now, like I said, there's a few concepts. I'm gonna try and make sense out of them. No one else teaches this course the way I do, so there's no examples, no templates that I could follow that would help me help you. So I'm just gonna take it the way I think is best. Let's go here to OneNote. So I already have a video on this. If you go under the risk management course, where I teach you about risk to reward, but I left it there and not wanted to go deep into the other types of risk managements that are out there. But today I'm going to try and really speak about them. Let me try and highlight the specific ones we're going to be looking at today. OneNote is acting up. Oh, there we go. So the first one and the most widely known is the risk to reward ratios. Okay, so we'll discuss the concept there. The other type, and this one is a lot harder to achieve, and we might even not look at it today, but one that I spend a lot of time trying to crack: hedging. The next one is called scaling. And the other one is, gosh, I just have to look it up quick now. It's someone's name. Oh, there we go. It's Martin. But not Martin as the meat or the name of a person. Martingale. What else? One that just came back recently. Let me just remember what it's called. Oh yeah. Trailing stops. Any other suggestions? I know I'm the teacher, but your comments still help, you know. I'm trying to crack my brain. I've used so many of these things without naming them. We've got 5 on the board: risk to reward, hedging, scaling, martingale, trailing. Should we say partial closing? But it's more like trailing and scaling combined. It's a combination there. All right, so with the list that I have here, with this 5 risk management strategies that are on board, and probably not the only ones, there should be more, of course. Just let me know, which ones are you familiar with and which ones are you not familiar with? Tulani says margin, trading margin. Margin. How would we explain it? I feel like it deserves to be here. I just don't know how to explain it. And margin trading. I'm sure you mean making sure there's always margin in the account when you trade. And this has to do a lot with lot sizes and the leverage that you have. All right, so one to consider, one that's hard to explain. So from Mr. Khadebe, we've got trailing stops. He's familiar with that. What are you familiar with? I think it's more interesting to know what are you not familiar with? Then maybe we should look at that. Mr. Moses says you'd like to know more about hedging, scaling, and martingale. Ooh, ooh, heavy those ones. Heavy, heavy, heavy. Okay, so let's take one then. Let's just take the first one and just quickly talk about it. Move on to the next one, and then right after discussing all of them, then we might as well move on to the chart and see how this plays out in the real market. The first one on our list is risk to reward. I think everyone is very, very clued up with this one because it's quite out there. You wouldn't miss it as a newcomer in the industry. It's basically what every mentor shoves down your throat upon joining this trading journey of ours. Okay, so this is all about making more than what you lose. So if you're gonna be risking 1 rand, you want to make sure you always make at least 2 rand back, 3 rand back, and it could keep going. But the whole goal is to make sure that your risk is never bigger than your reward. All right. Now, this one here will be highly dependent on your trading system. All right. Because your trading system has to clearly define 2 points: entry and exit, the double E's. The exit, you can also name it SL, stop loss, or TP, right? The one that we really want here is the stop loss, because if you have your stop loss number, it will automatically give you a take profit number, right? So take profit is automatically set in accordance to the risk that you took. Okay, so there's no point in you looking at the profits that you're going to make. You're supposed to look at the negatives you might make. All right, and once you know that number, double it, triple it, 10 times it, whatever it is, that'll be your take profit. But you have to clearly define your stop loss, your risk. What is your risk? Because your risk will then give you your reward. Okay. Now, with this concept, we keep the lot sizes pretty much the same all around. Nothing changes. Okay. And then when we step into the field of hedging, hedging is all about buying and selling at the same time, right? So here there's no stop loss, all right? So let me show you what I mean by this. Let's draw a quick example. Say the market has been moving down, and at this point here, you anticipate that it will start moving up from there. So you, with confidence, take a buy trade over here. But you decide that, you know what, if it happens that this market goes below this level here, the risk to reward trader would say this is a stop loss. This will then be a sell for us. Okay, so which means if you entered here with, let's say, 0.10, the cell itself will also have to equal that. Okay, now the market goes for a buy, but before going far enough to take profit, it comes all the way back, goes through the sell, which would have been a stop loss if you didn't. And as soon as it hits the sell and it activates it over here, you are now locking in the negatives. Okay, so this trade here and this one down here create this small area here. I'm just going to shade it for you. All right. They create the small area and they lock in negatives. Okay. So from here on, you're no longer making or losing any money. Why would you want to go through this? Why don't you just hit the stop loss and just kill the trade and start over? Because you're not a risk to reward trader in this instance. You're a hedge trader. You're trying to hedge the position that you're currently losing, but you are freezing it. So in this moment, it's frozen. Even if it moves up or down, the buy is gonna lose in proportion to how the sell is gaining, and vice versa. So the negative will pretty much stay the same. So if you're running here a minus $10, for instance, that's what it's going to stay no matter how low the chart goes. So let's say the chart keeps going down, and we've got some support here. So this here gives you confirmation again. Your strategy gives you a new confirmation that, listen, dude, you should buy here again. You know, I know I was wrong, but according to the strategy, you should buy. So you decide, okay, bud, you know what? I'm going to take this buy. All right. So you take another 0.10 there. So as soon as you take this buy, what you do then is take the profits that you've made from the sell. All right. So what you realize is that the sell had moved from here all the way down to here, and you should have taken profit here. So all of this is profit, but from the sell. So your buys are still in negative. So as soon as you eliminate that sell trade and taking its profit, this margin is then added onto your balance. Okay, so let's just, for example's sake, let's say you made yourself a positive $15 in that trade. This means you're still in negative 10 by the time you release this trade over here. Okay, and then from there, the market then, sorry about that. Obviously, you have to set up the next stop loss down here. All right, so you'll have another sell, but this one is pending, it's not active. But for now, it has to equal the combined lot size. So here would go in with 0.20. Trying to protect that market right over there. And then the market goes up, comes down, but not quite to the sell order that you had. And then it starts moving all the way back to the first trade right over here. So at this point, all the profit from this buy trade have been secured. And this current buy trade up here is running a 0. So now you've got the option to close all these trades. And let me just number them to make it easier, because it's kind of getting hard. So this is buy number 1. Geez, why is it that big? Undo. So this would be trade number 1, the buy. The sell here would be trade number 2. And this new buy here would be trade number 3. So let's put them down here. 1, 2, 3. So with trade number 1, it's currently running on $0. Okay. With trade number 2, we did a positive $15 from the sell. Let's just show this is a buy, this is a sell, this is a buy. And from trade number 3, we've made profit from here to there. which would have given us, for example, let's just say $25. So all in all, even though you ran some negatives, you were able to hold the trade to the next signal or to the next trading opportunity before you released that trade. So let me give you here. So in total, you'd have made yourself 40 US dollars from this trade. Okay, so obviously I am going to show you an example of what I'm talking about here. But do you get the example? Are you with me so far? I don't want to move on to scaling before you guys give me a confirmation there. Let me just move this to the side. Let's create some space for ourselves. All right. So hedging is nice, but it requires you to understand your strategy. If you don't follow your strategy, like literally to the T, you might miss the opportunity to go out with an exit. All right, seems everything is clear so far. Nice. Now let's look at scaling. Scaling and what do you call this? Scaling and Martingale, I would say, are brother and sister. All right, brother and sister in the market. Well, there we go. Okay, what do I mean by this? When we scale into a trade, we basically trying to take more positions in the market. Instead of taking one big trade, you're trying to take more trades, but scattered across the what do you call this? Scattered across the chart. Now let me try and draw it in. I think it's easier seen than done as well. So with this one, say you've got trader A and trader B. Now both these characters are experiencing or looking at the same market. So this now market is now moving down, went up, is now at this point. Okay. Bam, bam, bam. All right. So they both decide, you know what, this is a great point for me to buy. So they both want to buy this trade and move up with it. Okay. So trader A says, listen, I'm going to take a buy right over here, say for maybe 0.10. I think it's a nice solid number there. All right. And he's going to set a stop loss down here. Okay. Say this market then moves from all the way down here to here. He would have lost a total of, let's quickly round it off, let's say minus $100. Okay, I'm just being crazy. I'm just being crazy with it. But if this trades move all the way down to his stop loss, he would have lost $100 from this trade. Versus trader B, who also wants to trade 0.10 in full, but doesn't want to put it in the same area. He would rather scatter it across the same distance. So he's also planning on taking a stop loss down here. Okay. So obviously to lose $100 with a 0.10, this would mean this distance from here to down here is 100 pips. Now, just to round it off and make it easy on everyone. So obviously we know that the distance between this and this is 100 pips, but this guy doesn't want to take all the risk at one price level. He wants to scatter that risk. So he decides, okay, cool. With the first trade, I'll take a 0.01. Okay. And then halfway through it, so at 50 pips, he's willing to then take a 0.04, for instance. And then right before the stop loss over here, let's say just 10 pips away from the stop loss, he's willing to then take a 0.05. All right. All in all, he's still going to execute 0.10. But when it comes to the risk, he has a cushion towards it. Now let's look at this. So if the first trade number 1, moves from here and goes all the way down to stop loss and hits it, we would lose from that specific trade $10. Okay. And then if trade number 2 also moved from its point, which is at 50 pips, all the way down to stop loss, which is 50 pips away, we would have lost ourselves there. $5 times 4 equals $20. So this trade has a total risk of $20. Okay. And then the last trade over here, which is then just 10 pips away. So let me just punch in the numbers here. This is 100 pips. This is 50 pips, and this is 10 pips. And let's zoom in. Okay, so in 10 pips with a 0.01, that's $1. 0.05 would be $5. This trade would then be a $5 risk on that trade. All right, now here's where the magic comes. When we add up these numbers, the total risk here, if we hit stop loss for trader B, would be $10 plus $20 is $30 plus $5. It's equivalent to $35 risk versus this guy who's lost $100. Are we togetherness? This is the art of scaling into a trade. And also don't mind the lot sizes that I'm using over here. All right, I could keep them the same. They could all be like 0.01s, 10 0.01s, just going all the way down. Doesn't matter. I just like increasing on it because I like to put the biggest number closest to the stop loss so that it doesn't cover a lot of space. And all the small trades would be right at the top where I'm not where I'm unsure of the results of the trade. All right. So we've reduced the amount that we would lose, but we haven't reduced on the pips that might go. Okay. Say now things actually did work out and the market didn't crash all the way down. The inverse would also apply for this person. So if the market maybe just went down and then went all the way up there, obviously, if this happened to this guy as well, he would only have one trade activated and it would go. Okay, so by the time this guy maybe makes a positive $100, this guy will only be making a positive of $10, for instance. Okay, so it sucks if the trade, if you were correct immediately, then it would have sucked for you. But what if the market actually went down? So let's say they went all the way down to 10 pips, close to your stop loss, and then they went all the way up to here. Okay, we're gonna imagine that the distance to take profit, which is over there, is the same distance we're covering. So it's still 100 pips to there as well. Okay, so the same thing happens to this dude here. The second trade gets activated, the third trade gets activated just near stop loss, and then the market moves all the way up to 100 pips positive. All right, let me see if I can create more space for us here. It's just getting bad. So there we go. Give me a second. I'm going to redraw this for you. I need it perfect. So the market came down. Went up. Then went down. Shapes. And then it went all the way up there. All right, so we took a trade way. Our first trade was here. Say halfway through that, this was the next trade. Then 10 pips away from the stop loss. This was our last trade over there. Okay. What do I want to do now? This, that. Copy of this dude. Put him right over there. Let's create some distance right over here. All right, so still same example. We know that this guy would have made a loss of $100 if he hit stop loss. This one would have lost a total of $35 if he hit stop loss. But in this case, they haven't. This guy's still in that trade for over here for the buy with a 0.10. This guy has 3 trades, this one here, this one over here, and this one here. So this one is a 0.01, this one is a 0.04, and this one is a 0.05. Now, the price has moved all the way to this level, and we're assuming that it's 100 pips above this level, and this is also 100 pips. So just put there 100 pips, just for example sake. 100 pips. So this means if this guy's trade actually moved from there without hitting stop loss and got to 100 pips, he would have made a positive $100 in profit. That's his take home. He's done. He's going home with this. Okay. Now the difference between him and this guy is that the first trade will also move up to the 100 pips. I think I need another horizontal line to go there. And so this is our take profit level. Okay, so as soon as we get there, we've hit 100 pips. But notice this. He's got 3 trades that are going there. Okay, and all 3 of them have different pip value. Okay, now we set the distance between trade 1 and trade number 4. Trade number 2 here is 50 pips. The next distance here would be 40 pips. And then what's left over here is 10 pips. which means the distance from here to the stop loss is 100 pips. So if you add this pips up, they should give you 100. That's all I'm trying to say. So the market moves up. It means this guy here moved for 100 pips. So 100 pips at 0.01 will give you a profit of $10. This guy has moved 50 pips plus 100 pips at 0.04. All right, so that's 150 pips. That's $15 times 4. This would mean he made himself here $60. And then with the last trade, he moved 90 pips plus this. So 90 pips with a 0.01 would be $9. All right, $9 times 5 would give you a total of, why am I lying? 0.05 in 190 pips. Be $19 times 5. Yeah, my maths almost failed me there. It has to be a bigger number. So 0.01 in 190 pips would be $19. Multiply that by 0.05 would give us $95. All right. So in the worst case scenario, this guy would be able to bring a total of 90 plus this would be 105, would then be 165 US dollars. So he's able to make almost 65% more than the person. And also the risk itself is reduced down by 75% in the worst case scenario. So in the worst case scenario, trader number B will definitely keep his account alive longer. And if he makes the profit, he will definitely make more than the person that took one lot size. All right. So are you with me? Is scaling making sense now? So you can also scale in the direction of the market. I think you guys have seen a lot of traders doing this. I just want to minimize the size of our drawing here because we need the space. All right, let me know. Are you with me? Are you understanding what's happening here? This is scaling. All right, so you don't need to just scale in the opposite direction of the market. You could also scale as the market moves in your favor. I think you guys have seen me do this. Let's say the market is now moving sideways and you draw your trend line here, you draw your other trend line here, and you're saying if this thing breaks out and goes up, I'm going to start buying it. So instead of waiting, you just start putting the buys in. Buy, 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 buy. Let's say maybe you've made them 0.01. All right. This is still scaling into the market. All right. And then luckily the market jumps out, picks up the first order, scales into the next one and the same one and the next one and the next one. And now you've got 4 trades that are all equivalent to 0.04 that are in profit. All right. So this works well for guys that are trying to take a big risk, but they don't have enough margin to go with it. So as the market goes, as we activate the first trade, it makes profit. That profit can then be used to activate the second trade. Those two make profit. They use that to activate the third trade. Those 3 make profit. They use that profit to activate the fourth trade. And now you've got a chain of profitable trades just running in the market like that. All right. So I've seen quite a few traders do that, trying to max out on the lot size, and you just end up having like a billion trades with a 0.01. You're trying to max out on the profit as well. So as you make profit, you're converting it into a new trade, a new trade. Um, so yeah, I just don't like it that way. I like it in reverse. As we going towards the stop loss, not towards profit. Because as the market turns, it means you just have a lot of trades stacked up right to the top. Imagine if you kept going with it. What the hell? Oh, there we go. I lost my pen, just like the president lost his iPad. Funny guy. So yeah, let's say you kept stacking, you kept stacking, kept stacking, kept stacking, kept stacking, and you're stacking up to infinity, and this trade decides to go down. This means you'd have stacked up to the highest point, and now it's all coming down on you. You're gonna blow that account. You will blow that account. Making sense? All right. So I would recommend personally scale opposite to the market, meaning towards your stop loss, because that's the only way you're going to control that risk, in my experience. All right. So we've got a question here from Mr. Nell. It says, scaling and scalping, are they the same thing? No, sir. Not at all. Not at all. They're not the same thing at all. So when we refer to scalpers, we're referring to people that trade short time frames, small time frames. And when we refer to scaling, we're talking about the way you activate your trades. Yeah. Just like you're activating multiple trades. All right. And then my favorite one. This one is a legend because it's broken a few casinos. It wasn't originally a forex strategy. It was actually a strategy used by a mathematician named Martingale, who wanted an edge over the casino. So he realized that if he kept doubling his money, okay, so let me get to it with diagrams. So this guy realized, okay, cool. The casino, the house always wins because they've got a probability advantage to win. So if you gamble long enough, you will lose your money. So he chose a pretty neutral game to play, but still the edge was for the casino. I think all of you know the roulette table. Let me see if I can. For those brothers and sisters of mine that don't know what roulette looks like. As soon as I type roulette, Martingale comes on board. Same time. Roulette. Yeah, I think this is a nice table. Please, even though I'm showing you this, I'm not saying go to the casino and start gambling and think you can do it. Obviously, after he cracked it, they also changed the systems. I think this guy's just like people making money. So here's a roulette table that made Mr. Martingale a champion for gamblers. Right now, I'm not saying in any way that we are gambling. All right, so he chose this table because the odds were stacked properly. Like you would have 49% and the casino would have 51%. But if you play long enough, the casino will beat you because of that probability advantage they have. So he decided, okay, cool. Since I can play colors. So you see the red color here and you see the black color here. It means there's a 50-50%. There's how many are there? Let me not. There's 18 red colors and there's 18 black numbers here as well. All right, so it's like a 50-50. It's either it lands on red or it lands on black. Okay, there is a green one, and this green one, this zero, gives that extra 1% to the house, to the casino, and that's the one we're not going to look at. So we're just going to completely ignore that one. Okay, so he was saying, okay, cool. So if I bet, this is how the roulette table works. If you bet colors, so if you bet a color, let's say you go for red, and you bet $100. If you win, the house is gonna pay you back $200. So you'd have made a profit of $100. Basically, it's like a 1-to-1 risk to reward ratio there. But in total, what returns back to you is $200. All right. So he understood the concept very well. So this is kind of working on one is to two. That's the whole thing. All right. So he decided, okay, cool. I'm gonna start my bets very small. I'm gonna start off with a $1 bet. If I lose that one, I'll go in for a $2. If I lose that one, I'm gonna combine the two losses together and I'll go in with a $3. All right. If I lose that, I'm gonna basically add up all the losses that I have and go for $6. And this will keep going until he wins. Okay. Now you're asking yourself, how would this help this man? Remember, when he wins from the $1, he will make $2. If he doesn't and he wins here, he would make himself $4. Here he'll make 6. Here he'll make 12. All right. So the whole martingale thing is about taking your negatives and adding them up, and then taking that negative as a bet, trying to make double what you've put on the table. Okay. So this is how it would work out. Let's say he lost the first trade, lost the second one, lost the third one, and only made money on this one over here. This is how it would have looked. He would have lost $1, lost $2, lost $3. All right. And then took the last gamble of $6 and made $12. So here you'd have a plus 12. So if you add it all up together, he was able to walk away with 6 minus 12 equals $6 in profit. All right. Now, this is considered one of the most riskiest strategies to trade because the negative here is compounded. It's growing compoundly. Because now let's add up what's here. It's going to be what, $12 to make 24. If you add all of this up, this will give you $24 to make 48. And then you'll have to risk 48 to make is it 800 and not 196 dollars, and so on. So you can see that this number here is rapidly growing. By the time you get to 48, it's already 2 times that. You've already blown $96 on that. All right, but it's giving you more than one chance. It's giving you 1, 2, 3, 4, 5, 6, 7, and you can keep going. So do you think that if you had to trade 7 times in a row using your strategy, you would lose 7 times in a row? That's the question. And that's what Martingale was going for here. All right. So he wanted to give himself enough chances to win. So he would take a loss, take a loss, take a loss until he maxed out his money. So he went in prepared. He took in exactly what he needed. He was like, okay, cool. I just need 10 chances. There's no way the house is going to beat me 10 times. So once he's chosen red, he's going to go with red all 10 times, hoping that he's going to win. And when he gets that win, he recovers all his money and makes profit. Then he can walk away. All right. So that's Martingale. All right, someone would say, so what's the difference between scaling and martingaling? With scaling, we don't add up the negatives. If you hit stop loss, you hit stop loss. It's game over for you. You can go try on another chart. With Martingale, every loss adds to the next trade. So you must have more than enough margin when you're martingaling. All right. So how was that for martingale? Are you guys now more familiar with the concept of martingaling? Let me know in the comments. So we just covered martingale. So there's really a small difference between the two. One adds onto the risk. One just simply spreads out the risk. So most of the time when you see me trading, I'm using martingale. I know it's super dangerous, but as dangerous as it is, it's also one of the most profitable systems you can implement. And I'm referring to risk management systems. This has nothing to do with your trading system. Your trading system is the one that tells you enter here with a buy, enter here with a sell. That's a trading system. It picks up entries and shows you where your stop loss is. Okay. Now you can then decide, am I going to take a stop loss and a take profit with a risk to reward? Or am I going to scale into this trade in such a way? Or am I going to hedge the position? Or am I going to martingale if I lose this trade? What is it that I'm going to do? All right. So scaling doesn't even need a stop loss. You can keep scaling in and keep going. That's not martingale. You're scaling into the market. Okay. And when you martingale, you take a loss, you add that loss to your next trade, and you always make sure that when you win, you're gonna recover all that money. So you can also martingale with a different risk to reward ratio. You can martingale 1:4. Then when you win, you make 4 times that profit. Because with Forex, we're not restricted to a 1:2 risk to reward ratio. All right. Depending on your strategy, you're not confined at 1:2. You can go 1:5, 1:10, make 5 times, 10 times, whatever you are risking on the table. But the fact is the same. I'm martingaling it. I'm adding the losses. Okay. So it would even look greater if it was that way, if it was a 1:5 risk to reward ratio. Let me show you what I mean by that. Remember here we're using 1:2. Okay. Next door, let's use 1:5. You know, if your strategy gives you 1:5, we have to talk about it. You're sitting on money, you're sleeping on money. Okay, so that's trade one. So that's $1. This is then $2, $3, $6, $12, 24, 48. All right. You're trying to make $5 back from that dollar. You're trying to make this should be what, $10, which is 5 times more. This would be $15. This would then be 5 times this would be 30. 5 times that would be 110. And then my maths went. You can use a calculator for this exam. Times 5. No, that's impossible. Then 24 times 5 equals 120. Then I'm lying. Then 12 times 5 equals 60. Yeah, what a lie, bro. Cease. Shame on you, devil. You guys just watching me do this. So this is 60. Then it's 48 times 5 is equals 240. All right. Then let's look at this. Say you lost this guy, lost this one, lost this one, lost this one, and made a profit on this one. Okay. This means you would have had a -1, -2, -3, -6, plus 60. Total there would be 6 plus 6 is 12. 12 minus 64 would give you $48 profit, which is more than what you've ever risked on the table. Okay, so the higher risk to reward ratio with Martingale gives you a competitive edge in the market. Okay, you'll end up like me, happy to lose. And then the last one is trailing stops. All right, so trailing stops is all about if your trade runs in profit, what do you do then to protect it? But this really doesn't take you away from the core strategy, which would then be linked back to your risk to reward ratio. Because if the trade doesn't go in your direction, you're going to hit that stop loss anyway, and there's nothing you can do. But say the trade goes in your favor, say the trade was moving up, going up, and as it was coming down, you took a sell trade here. And it went, showed you some profit, created a new resistance and started moving down. Now, instead of having your stop loss sitting up here, which would be your initial, as the trade started over here, this would have been your initial stop loss. Okay. But then as time went by and you created new supports and resistances, your stop loss was then shifted to this new resistance, which is over here. All right. So at this point, you've guaranteed yourself profit. So no matter what happens, this profit here will go home with you. So let's say the market keeps going down. They come back to scare you, and then they move back down. You can then again adjust that stop loss. No. Adjust the stop loss. Move it. Oh, geez, no, don't do that. Don't move everything. Listen, dude, I just want the stop loss. Just give me the stop loss. You can then move it lower to the next resistance point, maybe over there. Okay, so this means all of this is guaranteed profit. And of course, as the price is here, all of this is profit for you. All right, so but this is all about maxing out the profit and making sure that you don't walk away with a negative. Whether you're sleeping or whether you're awake, your stop loss will have you. So your stop loss doesn't have to be negative. It can also be positive. All right, so that's about trailing stops. That's what it's all about. +8. When the hell did we get to this time? No, tell me my watch be lying. Oh, hell no. Well, that class went by way too fast. We couldn't even take examples. So I think we'll take examples in the next one. We'll break it down. We'll first look at the risk to reward, then do hedging, and then maybe in the next class do scaling and martingaling. But if you understand the concept of what I'm speaking about here, Please, please try it out. Start a live chat with us and let's talk about it. Let's talk about it. I'm always willing to chat. I love chatting. All right. So any questions before I go and live my life? And you guys go back to your families as well. Which one touched you today? Which one do you wish you knew before you blew an account? Hmm. Tulani says he didn't even know about this, but it's all clear now. I think he was referring to Martingale. Am I correct? Was it Martingale? Oh, so excited. I finished 4 days in a row, man, teaching. Oh, I miss this. Yeah, because my life is between three roles that I play. I play the IT guy, so I do all the programming. Um, so when I'm doing that, I can't do any teaching. I can't be online because I have to crack my head thinking about JavaScripts, Python scripts. It's getting crazy out here. And then from there, I move into the role of teaching you, becoming this guy, which I really prefer this over anything else. Um, and then my other role as an account manager, as a sales rep, you too much, too much, I tell you. All right, I guess there's no questions in the house. Maybe I should give you 5 more minutes. So okay, I'm gonna give you 2 more minutes. You've got till 7:15 to get me those questions, and I'll answer them. If there's still no questions, I'm gonna say my good nights and get the out of here, man. So yeah, think about it. What is it that you wanna talk about? Like you've seen all of this. What's not clear? What do you need clarification on? All right. So no exact questions. I think, like Tulani says, he'll wait for examples on the chart for the next session. So yeah, join me next week Thursday. That's where we're gonna be doing it. Mondays the beginners, Tuesday intermediate, Wednesdays advanced, and then Thursdays risk management. So we're gonna look at a lot more examples. Um, I mean, these classes are meant to be practical. So come with examples, send me charts way beforehand, and we can discuss them here online. Until then, I'll see you guys next week.